Okay, so we are going to be looking at what? Input, output, decision making, right? Input, output, decision making, and we start with the relationship between inputs and outputs. In a business, you should be able to tell what is the relationship. What do you get for what you put out? That is the relationship. So you know that Y is your output and X is your input. So for every X units I put in, I get Y, and F just simply means a function. So Y, which is the output, is a function of the input. Yeah, so let's define this terms clearly. Y we said is output and X is input. Yeah. One thing to take note of is the output can also be the total physical product or total product. So when they ask you total physical product, you know that is simply what? Total output. Simply total output. Now that you know total output, you can go ahead and find the average what? Physical product. Meaning that I get X out per input. Now let's give an example. Maybe you have a business and you put in 10k. Well, every 10k you put in your business, you get what? You get 90k.
Yeah, 90k. Yeah.
So for every 10k input, it gives you 90k output. Whatever k can be, whatever it can be, shillings can be, kilograms can be, whatever. So you know that on average, for every 90k I get 10k. That means my average physical product is simply 9. APP, average physical product, is simply 9. So average physical product is simply what? The total physical product divided by the X. But remember, total physical product we said is the same as is the output, is the total output. So you can say Y divided by X. Okay, so our average physical product is going to be 9 in this case. So remember we said average physical product is total product divided by the inputs, which is the same as, and we say that total physical product is the same as Y divided by inputs, which is X. And that's how we end up with average physical product. Now that we know average physical product, there is now another term which is marginal physical product. Marginal simply means additional. The additional output for additional inputs. Additional output for additional inputs. As simple as that. That is what marginal is. So for if you are to increase your inputs, let's say by 10, how much do you get? So you notice that at the start you keep getting high, but over time it keeps reducing. That's the law of diminishing marginal returns. It's in simple terms. It is at the start, the first. You give an example of applying fertilizer in a garden. The first bag of fertilizer you apply will improve the yield by so much. The second bag by much, but not as much as the first one. The third, like that, keeps reducing, and you even reach a point of negative returns. So you have a point of increasing returns, diminishing returns, then negative returns. Let me illustrate that with a graph. We have our graph. And the first point is increasing. This is how an increasing curve looks like. This is an increasing curve. Then you reach a point of diminishing. It peaks, then it starts. Then you reach a point of decline. So this gives us 3 points that I can clearly mark for us to see. So our graph has 3 points. We have increasing returns, we have diminishing returns, and we have negative returns. So let's go back to that example of fertilizer. I oversimplified it. When you apply, let's say you have an acre and you apply just a cup full of fertilizer, yes, it will increase the yield, but not as but if you apply now 2 cups, okay, in simple terms, there's a point of increasing returns whereby when you add, maybe let's say if you add 10 units of inputs, you'll get the first one will give you maybe 50. Then you add again more 10. The second 10, it will give you maybe 60. You add the third 10, gives you 65. Like that. That's the point of increasing. Then you reach a point where you add 10 and it gives you maybe what? Maybe it peaks at 70. Then from there again it starts reducing. You add 10, gives you 60. You add 10, gives you 50. Then you reach a point whereby you add 10 and it gives you 10. That is like your maximum. Then as you reach a point, you add 10 and gives you 5. So
that's a negative return.
This is diminishing returns. Diminishing. When you reach this point, diminishing returns. Then there's a point you reach whereby you add 10 and your yield reduces by 5. That is negative returns. So that is. Now back to the idea of marginal physical product. So we remember we're talking of additional units. That means what you have added, the total after minus the total before gives you what you have added. If I say maybe what your marks before were 80 and your marks after are 85, I've added 5 marks. So it is simply the change in that difference is the change in total input, the change in inputs divided by the change in outputs, or the change in total physical product divided by the change in
variable
in the outputs.
Those are.
Yes, so that is how we get our marginal physical product.
This output.
Yeah. Now
but I always see variable inputs as x.
Yes.
I always see variable inputs as x.
Yeah, x is variable inputs.
And I'm hearing outputs.
X is variable inputs. But I'm simplifying it and just saying it. Okay, so x is a variable input. Take note of that. It's an input but variable. So now you realize that these points can be summarized using an equation. Now between marginal, I want you to describe marginal physical product and average physical product. In the first case, which one is going to be higher? Remember, if you look at these formulas, they look alike. Average physical product is simply y over x. Let me write them here. Okay, marginal physical product, we say this is what? Delta y over delta x. Then average physical product is simply y over x. You can see that these two are related. Now, there are three across these scenarios: increasing, diminishing, and negative. Which one is bigger? So we start with
the
marginal product. Marginal physical product being greater than average physical product. This is the point of what?
Point
increasing of return. This is the point of increasing returns. Of increasing returns. Then actually it goes from increasing up to, I think it's up to this point if I'm not mistaken. Let me first confirm. Then we have marginal physical product being equal to average physical product. That is then we have a point where the marginal physical product is less than the average physical product. This is the point of diminishing. The additional you're getting is less than. This is diminishing. This is the optimum. Let's go and confirm. Yesterday I was clear about this. Maximum profitability loss. Okay, after that, after marginal physical product, we now go and look at where is that curve? We now look at the concept. We bring in marginal value product, and then we are going to compare that with marginal input. MIC is marginal input what?
This one, it is called marginal input. No, it is marginal input cost. It is
Marginal input costs.
marginal input cost.
Okay. Now
We are working on this thing.
yes. Now this we are dealing with quantities. X and Y are quantities. Now we want to convert it in terms of money. That's why now we are going to bring in the idea of price. So we shall start with the marginal value product, which is simply the value of the additional product. So you get the marginal physical product times the price of the output, which is Y, PY, and you get the marginal value product. Then there's another term which is marginal input cost. What is the cost of the additional inputs you've added? Yeah. This is the cost of additional inputs to produce this. To produce the additional product. So the cost of the additional inputs to produce this additional product. Now this is where the concept of profitability comes in. We know just in simple terms. So here we are looking at gross profit. So we shall not be talking about fixed costs. We are talking of gross profit. So we shall not be talking about fixed costs. We shall only look at variable costs. So we know that for a business to be profitable, its total revenue must be greater than the total variable costs. As simple as that. Now you're going to realize that the marginal value product is the same as the total revenue. So this is marginal value product is the additional revenue. Okay. So now for a business to be profitable, its additional revenue must be greater than its additional costs, which is the marginal input costs. This is profitable. Then for a business to break even, its marginal value product, at this point you're maximizing profits. You're getting the most profits you can get, and your marginal value product must be equal to your marginal input costs. This is the maximum point of maximum profits. Then we have a point whereby the marginal value product is less than the marginal input costs. This is a point of a loss. If what you're getting after selling your product cannot even cover the costs, the variable costs of that product, you're making a loss. Yeah. So when you're after maximizing profits, you have to continue to produce. You have to go through all that point of increasing returns, diminishing returns, until you're approaching negative returns. That's when you've maximized profits. Because let's say, so how can I illustrate this? Should I do another curve? Okay, I think that brings the point in. And then after that, what did we cover next? Now we looked at break-even quantity. Now that we know this information, we looked at break-even quantity and shutdown point. So I'll start with shutdown point. If this equation, let's start with shutdown point. Shutdown point. So if you start a business, let's say you're a farmer, you have bought land worth 7M. You have put planting, harvesting, and all those things. Weeding, you spend 2M. Then at the end of the time you harvest, is worth what? After you package it and everything, is worth 5M. And now the question is, should you continue with this business or should you stop? And I will start first by calculating the profits. Our gross profit. Actually, let me start with net profit. Our net profit is total revenue minus total costs. And in this case, our total revenue was 5M minus our total costs were the variable cost, which was 2M, planting, and harvesting and all that, then the land which was 7M. So this guy is making a net loss of 4 million, right? This is 9, yeah. Net loss of negative 4 million. This is a loss.
Negative.
In the first year. So now the question is, would you continue this business, yes or no? And the right answer is yes, and I'm going to explain why. You'd continue this business because, of course, when you start a business, you cannot demand that in the first month of doing business, you've already covered all your capital and what. Some businesses take longer periods, others take shorter periods, but you should be able to see that there is a possibility of you recovering your money. That is the important part. So how do you understand that? Is by calculating the gross products, the gross profit, sorry. And gross profit is total revenue minus the total variable costs. And in our case, the total revenue was 5M, our variable costs were just 2M. So this business was making a gross profit of 3M. Yeah. So because this business is making a profit, it should not shut down. It should continue doing business. If you reach a point whereby your total revenue is less than your total variable costs, you should not be in business. Actually, immediately it's equal. When your revenue is equal to the total variable cost, close, because you're working at a loss.
But they say that you can't close it right by then. The reason is that you have to still compensate the fixed costs and what. The reasons are here. Some, however, often continue in production whenever, even when prices fall below the average total cost.
Total costs, not variable costs.
Average total cost.
Yeah. So you can continue in business even when your total revenue, when you reach this is shut down point SP. Let me just like shut down. You made your total revenue because your total variable cost shut down the business. But if your total revenue is less than your total cost, you can continue in business as long as on condition that your total revenue is greater than your total variable costs. Because if you open a business, let's use a simple example that you can relate to. You have a shop in town, but the profit from the money the shop makes after selling is not enough. Number one, replace stock. That is the number one. Replace stock. Number two, pay workers. And number three, pay rent. If the money you're making cannot do this, then you should close the business, unless you think that the business is going to grow. But assuming that the business stays at the same level of production of sales, then you don't need to continue in business. Yeah. Now we are going to look at the break-even quantity. So for you to break even, your total revenue must be equal to your total costs. As simple as that. And we say total revenue is what?
Total revenue
is our outputs, which we are calling Y, times, let's call it Q, quantity, because they are the same. Our outputs, Q, times the price of outputs, which is Y. And our total costs can be broken down into what? Fixed costs, total fixed costs, and total variable costs. So total fixed costs, we cannot change those ones, but we can express variable costs in terms of what? In terms of quantity. So it is quantity times maybe the price of inputs. Let me confirm if that's what we use. Did we use P what? What did we use? Price minus variable costs times quantity. Okay. Let me rewrite this.
This is the revenue.
So our total revenue is equal to the total costs. We know that our total revenue is equal to total fixed costs plus total variable costs. Total revenue, in terms of, if we had to express it into quantity, in terms of quantities, quantity times price, that is total revenue, is equal to total fixed costs remain the same. However, we can express total variable costs in terms of quantity, whereby we say total variable cost is equal to the quantity times the unit variable cost or average variable cost, which we are going to call VC. So it is Q times VC. Remember, we are finding break-even quantity, and at break-even, this is what happens. The total revenue equals to total costs. So now we want to bring this quantity on the same side. So we bring it this side. So Q times P minus Q times VC is equals to TFC. Are you following? So common term is Q. We pull out Q, what remains? P minus VC is equals to total fixed costs. Therefore, our break-even quantity, Q is quantity, break-even quantity will be total fixed costs divided by
P minus VC.
Yeah, our quantity that is equals to that, which is our break-even quantity. Yeah, TFC, total fixed cost divided by price minus variable cost.
How comes that? How comes that they divide? What they divide the variable cost by that? Yeah, planting, fertilizers, weeding, and pruning. This is for 4,200,000. Then capacity output, obviously. What do they divide?
What are they finding? What are they finding? Variable. This.
No, variable
Okay. So the question is, let me summarize it. A farm. Let's say a farmer, Chiamukama, supplies vanilla to a yogurt processor. He has the following production information: field hire and preparation is 150,000. So I can say that is a fixed cost, right? Let me summarize. Our fixed costs have told us is 150k, because field hire won't change whether you produce little or much, to cost you the same. Then they are saying planting, fertilizer, weeding, and pruning is 4.2 million. Those ones depend on what? They depend on your production. So I'll call those total variable costs 4 million, which is 4.2 million, which is 42k. Then telling us the capacity output of the field is 150 kgs. Output, the quantity output is 150 kg. And they're telling us the value of a kg of vanilla. Then the price, they're telling us, is 75k. And they're asking us, what is this break-even volume? We have already calculated the formula here. Our break-even quantity or volume, whatever you call it, is total fixed costs divided by price minus unit variable cost. This VC is unit variable cost, but we are not given that. We're given the total variable cost. You know that total variable cost is equals to quantity times unit variable cost. So our VC, we divide both sides by Q, will be total variable cost divided by quantity. So our unit variable cost will be, what's our variable cost? 4.2 million divided by, what is our quantity? 150. That gives us 28,000 as our variable cost. So we can go ahead and substitute. We know our total fixed cost to be 150,000, right? Our price to be 75,000, right? And our variable cost to be 28,000. So if we solve this down, we end up with 150,000 divided by 47,000, which gives us 3.2 kg. So this guy has to sell at least 3.2 kgs in order to break even. As simple as that.
Let us do this now. This one.
The question is saying, assume a poultry feeding company expects to produce and sell 20 bags in the coming 20,000 bags. So the quantity is 20,000 bags in the coming year, and at the price is 125,000 shillings per bag. When the variable cost per bag is, they've given us variable cost per bag, which is VC, 75,000 shillings. If the farmer has overhead, those overhead are fixed costs, total fixed costs, overhead of how much? 750 million. how many bags does the company need to sell to break even? So this one we go straight. Our total fixed cost 750 million divided by our price is 125,000 minus 75,000, and this straight away gives us 150,000 bags. Oh yeah, 15,000 bags. Sorry, 100.
If the company expect to sell 20,000 bags, how much profit will we use that
now
it's called a profit equation.
Yeah,
that one.
they're asking now if the company expects to sell 20,000 bags, how much profit will this farm make? That is the same as what? Net profit. So the net profit, what is it? Total revenue minus total costs. What's our total revenue? Price times quantity minus what's our total costs? Fixed costs, total fixed costs, plus you put this in brackets. What's our total variable costs?
Total variable costs.
It's Q times VC, and they're asking us. So we know our price is how much? 75,000. No, 125,000 from the questions given. So let me start writing from here. Net profit will be 125,000 times the quantity. They talked of 20,000 bags, right? Minus the total fixed costs, which was 750 million, plus our quantity of 20,000 times the variable costs of 75,000. So if you do that math correctly, you'll end up with our net profit as
no answer.
Okay, whatever answer you get. Yeah, that is it. So
yeah, I'm getting